everybody, and welcome to a special episode of Gold Rush. We have your usual hosts with you today. I am Sam Gatlin, an analyst at All Star Charts Gold Rush, and I'm joined by my better half, Mr. Jason Pers, another analyst at All Star Charts Gold Rush. And today we have a very, very special guest. We've had him on here before to talk about the mining industry, and we figured with all the moves happening in precious metals, it would be irresponsible not to have Kashop back on the Gold Rush show again, because last time it seemed like everybody loved what he had to say. Me, very selfishly, I want to talk to Kashop. He knows so much more than I do about the mining industry. I come to this from a very technical standpoint, so I'm not digging into the financials of Newmont and things like that, but Kashop has done that for a living in the past, and he combines the fundamentals with the technicals and has a very interesting view on the current market environment. So we want to talk about that today. We also brought some energy charts because I know Kashop has been eyeing some marine shippers and some other things going on in the energy space. So Kashop, thank you very much for joining us today, and I'm really excited for this conversation.
Hey Sam, I'm so happy to be here. Thank you for hosting me.
Of course. I see we have some action in the chat. We have Life New Snow. We have Robert. We have DPS in the chat. I appreciate all of you being here. If you have any questions for Kashop, shoot them in the YouTube chat, and we will be sure to get to them later in the show. But Kashop, what's on your mind right now? I mean, we got a Federal Reserve interest rate cut yesterday. If you want to throw up slide number 2, my good man, Jean Gauthier, we can talk about how the 30-year U.S. Treasury yield has been diverging pretty significantly from the Fed funds rate. So, do you have any hot takes on the bond market right now, or do you think the Fed has it wrong like they usually do? Because that's
My
kind of
my
how
hot take.
Jason and I have been leaning.
Yeah, so I think Jason and I have a very similar view here, and that is you want to just avoid all bonds. I mean, maybe you can stick to something which is in the 2 year or 3 year range, for the yield, but other than that, just avoid the bond market. It's a disaster. I know the Fed is cutting rates. I know they are doing QE. I know they are going to do yield curve control and so on and so forth. And there are all these reasons why, the central banks control the market. So you need to hold bonds, but no, just avoid it altogether and do something else. Because you will drive yourself miserable if you are just focused on a central bank catalyst for a trade. That is just not the way to do it. If you have a trade that is helped a little by a central banks, then sure, that's great. But if your entire trade thesis is the Fed will print money, they will buy my bond from me, and I'll be happy. No, you will not be happy. You will be miserable the entire time you are in the trade, even if you do end up making money. And as for the 30 years specifically, it's a disaster. It is absolutely a disaster. And the reason for that is the Fed may cut rates, but they only control the short end. And the 30-year bond prices in inflation expectations. And right now, that's going crazy. So if you look across from the United States and you look at Japan, the Japanese people are pricing in 11% inflation. And even in the US, if you look at where inflation is from 2020 levels, it's averaging something like 4% a year, which is 2x the Fed's target. So when you have inflation like this and the Fed says, hey, we see all this inflation out there, but we also see labor market weakness. And so we're just going to ignore this inflation and we are going to focus on the labor market. So what do? We are going to cut rates. And we are not just going to cut rates, we are going to increase reserves, meaning we are going to start printing money. And we are sort of going to start with 40 billion a month. And then, we guarantee you, we promise you this, we will cut it down to 20 to 25 billion a month. Now, I have never heard of a government program or any Fed program where they say we are going to stop and then they stop. They just don't. So if they start with 40 billion a month, it's going to just keep amping up and up and up. And that's why I think you see these giant moves in commodities. So silver's up something like 6%, gold is up 2%, Copper is almost back to where it was before the tariff crash. So you see all these moves in the metals, you see these moves in the miners. It is all just telling you one thing. The Fed is printing money and that money is going into commodities. So really just keep it simple. Forget about bonds. Focus on where the money is going. Don't drive yourself miserable. Buy gold, silver, the miners, pretty much anything in commodities, and you'll be much happier. It'll be a smoother ride.
I think that's the most important thing that we're talking about here, which is like everybody thinks about it like printing money or lowering rates obviously has to go into the stock market as a whole, like it's this magical thing where people don't pick anything. And really, like what we're saying here, and what Kashab have been saying for a long time, and Sam as well, which is the fact that money's flowing back into a specific sector based on the environment. We're in an environment where it makes a lot of sense to own commodities. The commodity index as a whole, if you're looking at this chart, you're basically seeing like a lot of energy. So if like this was equally weighted with gold, silver, and so on, like this thing would be probably near those old highs in 2008 at the moment. But at the moment, it's just like we're just waiting for basically one more group of commodities to start to catch up. Ags as well, I guess you could throw that in there as well. But energy is what we really want to see next. So let's go to the next chart, Sam. But if we go to the next chart, I want to ask you, Kashap, like we're seeing emerging markets. We're seeing that the dollar is continuing to make lower highs. I want to ask your opinion on the dollar here. Do you think this thing's going to just continue to move down? Do you think there's a possibility of it just raging up? And do you think it's just going to head down back to the 90s once again?
So I think the dollar is in a structural bear market. So this isn't a cyclical top, cyclical bottom, and an overall uptrend. This is a structural bear market where you're going to see lower highs and lower lows, meaning it's going to be down a long, long way. Something, yeah, like you said, back to 90s before the introduction of the euro, where the dollar was. I think there's a good chance that we get that. Now, I'm not saying that means you buy the offset to the dollar, which is the euro. I think that means you buy the offset to the dollar, which is all the commodities which are priced in dollars. And the reason for this move in the dollar is very simple. 2022, the Fed turned off the liquidity taps and the dollar kind of became a safe haven as asset prices collapsed worldwide. And then the Fed slowly started to reverse that and the bid disappeared. Then Trump comes in and he says, hey, we are going to do tariffs. And then the Fed comes in and says, hey, we are going to do QE. Now, all of this, what it does is it turns foreigners off the dollar on two accounts. One is the trade deficit. So the trade deficit is going to narrow. And what is the trade deficit? It is Americans buying cheap goods by exporting dollars abroad. Now you turn that off, then the demand for dollars abroad declines. Now, the other flip side of it is if there are less dollars abroad, then less of it gets recycled back to the US capital markets. And foreigners for a long time have been buying US assets because that's really been the best performing market in the world. So why would you not buy it? Now they are looking at moves in Brazil, in Chile, in Argentina. They are looking at all these other countries and saying, hey, maybe we should have our capital in those markets and not in the US market. So what they are doing is they are selling all their US assets, or not all their US assets. They are selling some of their US assets and buying exposure to assets denominated in other currencies. Now, this is also bearish for the dollar. So now you have these two forces which are both bearish for the dollar acting at the same time. And during this period, as uncertainty is going up overall in the world because you have two wars going on and then you have the tariffs, like, all the things that are going on in the world, like all the fear factors. So with all of this, the dollar is not a safe haven. The Swiss franc, sure, it is a bit of a safe haven, but it is really, really gold and silver that are acting as a safe haven right now. So in this environment, why would anyone want to hold excess dollars? They wouldn't. And that is why you see global central banks saying the same thing. They are saying we want to have higher exposure to gold than treasuries. So this is the year in which they did the flip where their treasury holdings went down below their gold holdings. Now, this is a trend that I think is set to continue, and that's for obvious reasons. Firstly, gold is rising up. Everyone is seeing the advantages of owning gold and silver, so hard currency that you control over the digital assets. And it's the same thing that's affecting the Bitcoin ecosystem as well. So Bitcoin used to be marketed as digital gold, which is better than actual gold. But investors are saying, hey, no, we don't want the digital version. We want the real version. So all of these forces are playing out at the same time, and it is structurally bearish for the dollar, which means it is structurally bullish for all these forgotten areas of the world where people haven't given it a second look in a long time. So, for instance, would you imagine 3 years ago thinking I want to buy a mining asset in Ecuador or Argentina?
You would have gotten
No
laughed out
way.
of the room, Kashop.
Yeah, exactly. Yeah. And that turns out to be a great trade. Turned out to be a great trade. So
So
even go
Kashop,
back to,
I'm curious,
yeah.
like with you, you have this thesis, which I tend to agree with for the most part, that the dollar is weakening, money is flowing into emerging markets in those areas. But if you look at something like the EEM, it has a lot of exposure to China, Taiwan, India, Korea, countries like that. That they don't really have a whole lot of commodity exposure, but they're still classified as emerging markets. So do you like those areas, or are you leaning in more to the areas like Peru and Chile that have a lot of precious metals and base and industrial metal exposure?
No, great question.
So, yeah, so like you point out, there's a split between the commodity producing emerging markets and the commodity consuming emerging markets. But at this point, it is a rising tide lifting all boats. So when investors are saying less allocation to US assets, more as allocation to international assets, they are going everywhere. There will come a point where you will have to be picky and say, I don't want exposure to India because if gasoline prices are going up and they don't have cheap Russian oil, the economy is going to get hurt. So that point will come. I think that is maybe 6 months or a year away. And as for China, so China, the last bull market was in 2014. That was the time every fund manager in the world had to own Tencent and Alibaba and Baidu and all these Chinese companies. So just like the Max 7 of today, you had these Chinese tech companies and they had to be in every fund manager's portfolio or you get canceled. So that was more than 10 years ago. And 2024, when I think it was around March, when Chinese stocks hit bottom, the sentiment was do not buy anything Chinese because once Trump comes in, all these ADRs will get delisted. It happened to Russia before, so the fear was real. So the valuations kind of went down to a point where doesn't matter it's a commodity consuming nation, the valuation just got so cheap that you couldn't ignore it, and now it's mean reverting. So there are both those factors at play. Right now, I think you just buy everything, but there'll be a point where you become more choosy and pick the commodity producing nations over the commodity consuming nations.
Yeah, I really like the idea here of like, I mean, I keep saying it over and over again. I really like Latin America. I mean, Sam and I were just on a call talking about like banks in Europe, like Deutsche Bank, like it looks good. Like these are weird things I haven't heard said. Citibank, somebody said, I haven't looked at a city chart in years. So somebody said Citibank looked good. Like we're kind
It's
of
still
seeing,
like impulsive for me to call it the shitty bank. Like it's hard for me to call it the city bank because it's just been so bad for so long.
yeah, and same with Deutsche, like all these things
Yeah.
have been crap forever, and like we're kind of seeing this, and really like my main point here is like it's kind of inside of that one trade that we're talking about here. Like I don't know if I really want to be in Europe in the long run. I'm long it currently, but at the moment it's like it's kind of part of what Kashop's talking about. You see this big move in things like China, Europe, and so on. And I think that'll start to move into other areas at some point soon, probably South Africa, probably Latin America. Canada looks really good currently. I don't know if that's sustainable long run, but like once again, it's like you're going to see this shift, and we're going to keep continuing to move into these more commodity based countries because some of these countries have zero tech, not one tech stock, zero tech stocks, and those are the ones that are outperforming the most this year. I mean, we're seeing these 50% plus returns while the S&P is up what? Is it up 20% now this year? Did we finally hit 20?
Something like that. But
I remember
what it
17
comes
was
down to
last week.
me is like, Kashop hit the nail on the head. He said, a rising tide lifts all boats. I think that's exactly what's happening here. So like, yeah, Europe is going to work, but I think emerging markets, the more speculative, the Perus of the world are really the place to be. And that's what
That's
the
where you want to
currency
be.
market's telling us. We're seeing a lot more strength in the emerging market currencies relative to something like the British pound or the euro. Is that the way you see it, Kashab?
Yeah, I think that's pretty much it. Yeah. So, but I mean, you're not going to do badly by buying the British pound or the euros, but if you buy the more speculative currencies, I think you're going to do great. Now, some of these currencies have, again, systemic issues which make them uninvestable for the average investor, but then the ETFs solve those problems. So, watch for the launch of ETFs on these African currencies, the currencies which have capital control. So, I think that's going to be an interesting trade. This is being set up right now.
Yeah, I think we're in an area right now where we're looking at all these different areas in the commodity producing nations, but overall, I think the most bullish area I'm looking at right now is Latin America. So, Kashab, let's jump into a couple other things because I want to ask you a bunch of questions here today, and we got some time to get through them. So let's talk through like shipping. I wanted to just generally bring up shipping, talk to you about what you're thinking about the shipping arena at the moment, because we're looking at it and seeing like shipping stocks, shipping rates are moving higher, especially in wet shipping, and dry bulk shipping is not doing quite as well, but it's doing very well year to date. Usually we see these moves before we start to see the agriculturals and the energies start to move as well. So is this something that's on your radar at the moment? Are you looking at shipping stocks? Full disclosure, Kashab was talking about shipping stocks back in the end of 19 into early 2020, right before they had that major move. I always go to Kashab if I want to talk about the shippers. So Kashab, the floor is yours. Wonder what you're thinking about this shipping rates, shipping stocks, whatever you want to talk about on that.
Sure. So, yeah, I've been long shipping stocks in one subsegment or the other for the last 5 years, and currently I am more bullish on the oil tanker stocks, the oil and product tanker stocks than the other sectors. Now, I'm not saying the other sectors are going to do terribly or they are doing badly. It's just that I am more bullish. I favor this sector over the others, even though I'm positive on the overall industry. And the reason for that is you have to look at the geopolitics. So even though we sort of have a truce in the Red Sea with the Israel-Palestine conflict, so even though we have that truce, ships are still not moving. Ships are still not crossing the Suez Canal. Why? Well, because for the last 2 years, it has been a no-go zone, and people are reluctant to change their ways once they are set in their ways, and that's true whether you're an institution or an individual. So what's happening is there are two factors. So one is transit through the Suez Canal is still down, and the second is the Treasury, the US Treasury. They have been very, very active in sanctioning vessels involved in shipping Russian crude and Iranian crude. And I think we are going to be adding Venezuelan crude on top of that soon as well. So what this is doing is it's creating a two-tiered market. So you have these older vessels, which are say 15 years or older, which don't make as much money for their owners in the white listed market, which is the market which is compliant with the UN IMO regulations, the International Maritime Organizational regulations. So what these companies do is they sell, what these ship owners do is they sell into the shadow fleet, which is this big chunk of vessels which are involved in the sanctioned trades. And that takes supply off the market. Now, when you take supply of a market, it's economics 101. You're going to see the demand remains the same, the supply is off, rates go up, these companies make more money. It's as simple as that. The other dynamic is that you're seeing a lot of oil flow shift from the regular trade. So instead of China or India buying from Saudi Arabia, they're buying from Russia, they are buying from Iran. So what this does is it lowers the price of oil in the global market, which is one reason we have seen everyone's asking, why is energy not moving yet? Why is the energy not moving yet? Well, it's because you have a two-tier market, and that reflects on the price that you see on your screen. So this factor also affects the shipping space in the sense that when oil prices are higher, it is so much easier to justify the cost of transportation. Whereas when oil prices are lower, it is less easy to justify a higher cost of transportation. So I think when we start to see oil move higher and that move is coming, then these companies are really going to print money. And we should, I'm positioned for that environment. Now, if you look at the other sectors, so other than oil, then you have bauxite, you have coal, you have all these other raw materials which are transported in something called dry bulk vessels. Now, dry bulk vessels, they have a different dynamic. Firstly, they are much cheaper than the tankers. So they are not, they don't make as much in cash flow as the tankers. And they are also a lot easier to for the shipyards to make. So in this market, what you see is a sort of right now there's a sort of supply demand balance. But once again, as the demand for commodities goes up and the price of commodity goes up, then you're going to start to see these companies make uh, bigger profits as well. So I think that day is not right now. Is it 1 quarter from now, 2 quarters from now? I do not know, but that era is coming as well. Now, the third category that you have on here in your equal weighted basket. So I see you have some ships that are tied to the LNG trade and some that are tied to the floating storage, regasification. So those are niche sectors. They have their own dynamics. I wouldn't go too much into detail on that. And then you have a couple of them which are into the container ship leasing space. So container ship leasing, that's going to be a little difficult sector to operate in mainly because of the tariffs. So when you have these tariffs, you have these trade barriers, that's going to decrease the demand for global trade. So when that happens, these companies are not going to make as much money. However, if you look at a company like Danavos, so they are still making, I think, insane amount of profits. Their PE is under 6 or 7, I think, off the top of my head. So can the multiple expand when we have an overall bull market in shipping? Yes, it can expand. So you will make money in that sector as well. So overall, I think it really depends on what kind of basket you want to construct, or if you make this an ETF, your Gold Rush Marine Shippers Index, I'm sure if you make it into an ETF, there's going to be a demand for this product because it's very well constructed. So you don't have to do the work of trying to figure out which particular subsector in shipping is going to make money. You just buy the basket and boom, you're going to do very well in terms of both dividend yields and capital appreciation a couple of years out.
Nice. So anyways, so if we're looking at that and you're getting bullish on a specific sector, you're looking at the oil shippers mainly. Are we looking at the energy sector then to move kind of with it or after it? Is that how you look at it, or do you think about it a different way?
So I think energy moves when it moves, and we have to see some resolution to the whole inventory picture. So the reason crude is not moving as much is because inventory levels are supposedly too high. So once the market realizes that wait, inventory levels aren't exactly too high, that's when it's going to start moving. But whether crude moves or not, I think the shippers, the oil tankers especially, are still a good investment right now. And of course, once crude moves, then it's going to be even better.
Yeah, I think we're in that stage right now where it's like, okay, the IEA, they keep revising and keep showing that we don't have as much supply as people say, and people keep talking about Donald Trump. They're like, Donald Trump, he's going to make gasoline prices lower because that's what he wants. And like, just because you want something isn't how things work. And not to mention the guy is doing everything possible to run it hot. He just talked about they cut 25 basis points. He's like, we should have cut 50. It's a small cut is what he said. So once again, it's like he's doing everything to run the economy hot here, which is going to go into the commodities market, which is going to create a lot more inflation. And that's going to boost crude oil. The when is the problem. Nobody knows exactly when, but I'm sure it's going to happen. That's the thing. Like, I'm pretty sure of. I wouldn't be surprised if it happens sometime soon. Sam and I are still eyeing up that. I think they just had a split, so I think it's 50-50 is now that level to get above an XLE. But some of these stocks inside of the energy sector look great already. So
like the international stocks are already breaking out to the highest level since 2014. It's the U.S. energy stocks that are the laggards.
Yes, So we're looking at that. We continue to buy those areas. It looks like they're ready to catch up. We haven't seen a time where, gold, silver, copper miners, lithium miners, palladium, platinum, industrials, all of these are moving at the same time. And then historically, that's when energy moves. I've never seen a time where that hasn't happened. So that's going to be interesting. So getting into the next part of it, Kashop. So we're talking about gold a little bit. We got to talk about gold here at the Gold Rush. Everybody's excited about that. You and I have been pounding the table on gold for a long time. We've been talking about it for like basically since we do a show on Fridays. We've been talking about it every Friday for a long time, staying long. What are you seeing here? Do you think this is a continued trend? Or do you think that we're getting to the point where this thing's getting a little bit frothy, especially now with silver up 100 and probably closer to 120% this year now? I haven't looked today, but like it was
155% since the bull market started.
Oh, since the bull market started. Wow, that's awesome. So looking at that, Kashop, do you think this thing's getting frothy, long in the tooth, or do you think we've got more upside to go?
So, are we going to have a correction in silver at some point? I think yes. If that point is once the December contract delivery takes place. So I think there's kind of a shortage of physical metal, and this was something that was experienced in India about 2 months back. So they paused creation of units of the silver ETF in India because they couldn't source enough physical metal to create those units. And so the units that were already in the market started trading at a 10% premium. So I think dynamics like this just goes to show how little inventory or loose inventory of physical silver there is. I mean, you see a price that is traded on your screen, but when a big player goes to take delivery of that quantity of metal, it's just not available. So what this does is it pushes the price up. It also makes the silver contracts more volatile, which is why I think we will get a correction at some point, and it may probably be a little longer in terms of time, if not in price. But I think this move is absolutely sustainable. And even if silver hits $100, how big a deal is that? It's nothing. It was $80 it was $50 in 1980. It was $50 in 2011, and it's $100 in 2025, 2026. Well, that's nothing. That's just a 2x from its prior high, which is 14 years ago. So it's not a big move in terms of if you look at it in historical perspective. But if you're looking at the daily chart and you're seeing a metal move 6%, then that seems wild.
Totally. Jason and I have been talking a lot about all of the chart criminals out there who adjust their silver chart by inflation. Have you seen this, Kashop? People are telling me like to get back to 1980 levels, inflation adjusted, silver needs to get back to like something like $650.
So this one hurts Sam a lot. Sam,
it really triggers me. It's such a chart crime.
So it's like saying something has to get back to where it was at a prior blow off top doesn't make sense to me. It gets to where it has to based on the current market dynamics. And that's as simple as it gets, right? So it's supply, it's demand, and you see what's happening on the supply front, you see what's happening on the demand front, you see there's a lot more room to run. And you look at the long-term charts and you say, hey, this thing hasn't really run all that much if you look at it in CAGR terms. So that tells you that there is a lot more room for this to run. Now, if silver gets to $600 in 2027, and even if everyone is a silver bull, I can tell you for sure I would not be buying silver at that point. I may even be selling some of my silver, but I would definitely not be a buyer. But if silver gets to $600 in, say, 2028 or 29, well, then that's a sustainable bull market, depending on the path it takes to get there. So then I might still be a buyer. So it's all about the path that the chart takes. So I would never buy a Carvana, even if it's, zooming to whatever, $500 a share, right? Because I know the fundamentals, and it's the same way for silver. I know the fundamentals. I can kind of sense where it should be. And if it's there, then it's fine. What the inflation adjusted return is that's kind of irrelevant.
I love it, Kashop. You do a lot of really good fundamental analysis, but you're also a hell of a technician, I have to admit.
Thank you.
He's learned over the years.
Yeah, and I have to say all thanks go to Jason for that. He introduced me to Van Tharp and Alexander Elder, and then Stan Weinstein and Trader Vic, and I just kept reading, and it all made sense. I mean, I read
It's all
the
supply and
Fibonacci.
demand, right?
Yeah, it's all supply and demand. Yeah.
No, that's awesome. I love that Kashop, because when Kashop and I, we were both on like completely opposite sides of the spectrum when I think we met. I'm looking at just charts. He was kind of like the fundamental guy and he didn't understand it. And then we kind of merged quite a bit over the years and kind of share ideas back and forth. So it's been a great relationship between the two of us to learn a lot about markets. So let's get through some questions because we got a few questions in here.
Oh, before I have a question of my own.
Go
Kashaf,
ahead.
what are your thoughts on like the whole AI energy trade? Because I've
Ooh.
made this equally weighted basket of some of the AI energy stocks, and it looks really nice. A lot of people have been talking about the GE Vernova, which is like the big player in this industry. I'm not sure what their market cap is today, but maybe 150 billion. They're nothing to sneeze at for sure. And these stocks continue to work really, really well. So, what are your thoughts on the whole AI energy trade? GEV pushing $200 billion market cap, by the way.
Wow. I'm not familiar with other than the typical utilities. I'm not familiar with most of these names, but I will say that the best way to play the data center trade is to just buy natural gas or buy the
Ooh,
producers
I
of
like
natural
to hear
gas.
that. Nice.
Because over the
Yeah,
years, that's the direction we're going for sure.
Yeah.
so
Cool.
America
So, what
has
do you
so
like? Do you
much
like the
cheap
midstreams,
gas.
or do you like the producers of the natural gas? What's standing out to you in that
Well,
natural gas trade?
if you look at the biggest one, which is EQT, they are in both. And it's kind of similar whichever way you go. Now you go to Antero, then that's more of a producer. But sure, you can just buy the midstream as well because then you get a nice fat dividend yield. And as the Fed keeps cutting rates, these stocks appreciate in value mainly because of their dividend yield. So that's a nice trade. However, these MLPs, you can't buy it if you are outside the US. So that then for me, as a individual based in Dubai, the trade becomes just by the producers because I don't have to worry about complicated tax forms and withholding taxes. But for US based investors, I think it's both. You can buy the MLPs. MLPs again, I don't think they have had a bull market since 2014. So if you pull up I think it's the Alerian MLP index. I don't think they have made a new high since 2014. I could be wrong, of course. I haven't looked at it in a while, but yeah, I think the trade is both sides, the producers and the midstream.
No, I
Nice.
love
And
it.
Jason and I were just covering natural gas um, last week, actually, and we were looking at the seasonality of natural gas. And historically, like December, January, February is like the worst time of the year for natural gas. But I don't know if you've seen a chart of natural gas. It's been trying to break out of a massive base there. $5 really is that line in the sand. I know you've been kind of struggling at it this week, but man. It's really impressive to me how natural gas has been moving in a terrible seasonal stretch.
So let's hop into a couple questions before we run. So one of the questions I'll just answer real fast: palladium or platinum? Own both. Don't overthink it. Much easier to do. Like small positions in both. Obviously, they're highly correlated and they're very volatile. Small positions in both. Own both. Call it a day. You're not going to know which one's going to be the outperformer, and they're probably going to ebb and flow between each other. So we got an intermarket question. Do you think precious metals are sucking cash out of the crypto trade? I saw this and I was like, Kashop's the perfect person to ask this question to. So what do you think, Kashop?
100%, 100% they are. So I have been trading stocks on the Toronto Venture Exchange for, I think it's a decade now. And the complaint that the gold guys had when crypto was really taking off. So this is the period from 2020 to 21 and then this current bull market, so the 2023 to 2025 bull market in crypto. The complaint that these guys have had is all the speculative capital that used to go to finance mining projects is now going towards new crypto projects. And that was the case. And now what's happened is it has reversed. And it has mainly reversed because, well, Bitcoin has gotten too high, so has the market caps of most of these other cryptos. Whereas these mining companies, they were already so undervalued, and then they just got more and more undervalued because capital left the space. So if you go back to, I think it is end of 2023, the trading volume on the TSXV hit, I think, a multi-decade low. And from there, it's just mean reverted a little bit. So in a dynamic like this, you're going to see a big rotation out of crypto and into gold. And if you look at the biggest player in crypto, which is Tether Foundation, you can already see it happening. Tether now holds more gold in their reserves than Bitcoin. So this is a big crypto
That's so
company.
awesome, by the way.
Yeah.
I love
So
that.
it's interesting. So then last one, which is if we're talking about question was from Mark. Iron ore. He's wondering about iron ore. Out of all things, it's interesting. And for me, I'm always excited to have a conversation about obscure metals or futures. I trade these on the SGX. But what do you think about iron ore? Do you think there's anything there? Do you think like for me, steel stocks look great. Aluminum stocks look great. There's something there basically across a lot of these industrials and metals and mining across the board. So what are you thinking about iron ore or any of those sectors currently?
I love iron ore. And I think the way to play it is to own Champion Iron, which is a Canada-based iron ore miner, which they are going to make a very high purity iron ore concentrate. So the reason for that is iron ore is cheap and a big mine just came on in Africa. So that's going to add plenty more to the supply. So you really have to pick your spots. And the other dynamic in iron ore is BHP and China. They are kind of going through a spat right now over iron ore pricing, whether it should be in renminbi, and a lot of nasty back and forth going on over there. So broadly, you want to avoid the commodity, but look at Champion Iron because they have something that sets them apart, and they have been through the bear market. They know how to get through it, and they have great expansion. So if you can find companies like that, then own it. If you're just owning it as a commodity trade, just avoid it.
That's
Sounds good.
CIA on the TSX for all of you gamers
Yeah.
at home.
Nice. All right, guys. Well, thank you guys so much for joining us. This was awesome. Kashop, as always, just a blast to have you on, man. Where can people find you? Say a little bit about what you do, where people can find you, and how they could stay connected.
Sure. Thanks, Jason. So I run a newsletter at kashyapsriram.com. You can find me there. I'm very active on Twitter. My handle is at kashyap286. So I'm a cross-sector analyst. I currently have mining, which is a big focus for me. I also have luxury, and I have a couple of other sectors which are commodity focused in my portfolio. So just find me at Twitter, and you can get a lot of my tweets and shit posting for free. So I'll see you there. Yeah.
All
I
right,
love
guys.
it. You're the man, Kashop. Thank you for being here very much. It seems like the chat very much enjoyed this conversation. So shout out to everyone for showing up to this. We'll be back with another episode of Gold Rush, the same time, same place, next week. Until
Later,
then,
guys.
stay safe.
Thanks. Thanks, everyone. Thanks, Sam.